This is your Lead Left podcast for the week of March 25th. I'm Randy Schwimmer. Welcome back. Now that the liquid loan market is opening, albeit with mostly refinancings, larger issuers have more choices. This is actually a good and natural thing. For those companies willing to go through the ratings and syndication processes in the bank market, terms can be competitive. Because CLO equity investors benefit from much higher structural leverage, BSL pricing can be cheaper than private debt. This illiquidity premium or liquidity discount is historically 100 to 300 basis points depending on ratings. For quality borrowers, particularly in the tech space, leverage can also be higher. And of course, covenant light is the standard for syndicated loans. The paths borrowers can take depends on a number of factors. Because market and economic conditions have moved to risk on, liquid loan buyers are positioned to hold single B paper even when weak single B. Retail funds are now seeing cash inflows with $1.2 billion garnered over the past 5 weeks, according to Morningstar Direct. After months on the sidelines, issuers are capitalizing on a favorable environment by refinancing higher cost structures incurred in the past 2 years. As our chart of the week shows, pent-up activity has shifted dramatically from private lenders to the syndicated world.
Legacy BSLs have their own refi rhythms.
A lot depends on the secondary market. If prices rise, moving inversely to spreads, as they've been doing for the past 12 months, it's easier to take out the loans with a new, cheaper deal. If prices fall, as happened last week on the heels of tougher CPI data, it's a headwind for new primary transactions. This dynamic underlines the differences between public and private credit and how investment bankers behave differently than asset managers. Rate and economic conditions largely determine BSL appetite. At the moment, those are favorable, so that's good news for issuers. But as we saw in 2022-23, the pendulum can swing back, and when that happens, the liquid market shuts down. Much has been made in the press of private debt loan spreads contracting in 2024, but during the Fed rate hikes that began 2 years ago, those same spreads increased. How did that happen? Simple supply-demand. Doesn't that same rule apply to BSLs? In the bull market leading up to the GFC, as interest rates rose, loan spreads actually declined. When LIBOR peaked at about 5.5% in June of 2007, single B large cap spreads were in the 225 to 250 range, roughly half of where they started in 2003. Supply demand still ruled, but rate hikes then were more modulated, giving borrowers time to shop. Sponsors also pushed hard to keep all-in interest costs within a band over the period. Financing choices now include leading private credit managers who offer a wide range of credit solutions, including those for borrowers challenged by high interest rates. In some cases, this will be a convenient off-ramp for BSL loans. A glimpse of the future bank, non-bank ecosystem. Reporting from the private capital ecosystem at the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.